I'm
All
hi.
right. Go for it, Steve.
I can't see can people see me and I'm now unmuted? Is that correct?
You're all set to go, man.
All right.
Welcome,
Thank you.
Steve.
All right. Thank you, John. A real pleasure. It's my first time to meet your group, and I'm the owner and CPA of Aronson Professional Services. I'm sure everyone knows what the initial CPA stand for, but for those, including the gentleman that just passed the exam, it's not really certified public accountant. It's really constant pain in the ass. And let me tell you, it's all about the fun that you can have, right? You work hard, you play harder is really my motto. And to that vein, a little bit about me so that you have a little background about me. And I in addition to being a CPA, I do own properties myself. And I love to snow ski. If we have any snow skiers, I heard someone from Colorado was interested in what part. I happen to live in the mountains in Avon in the winter months during the what I call the ski tax season. Because if you work 7 days a week, you should be able to ski at least 4 or 5 of them, right, John? Don't you think?
And that sounds great. I have not been skiing in a while though, so maybe I'm doing something wrong in my life, Steve. I don't know.
Well, we all work really hard and we all try to get ahead. And sometimes you have to learn how to get to life balance. So for some of the young people that are here, work hard, but remember that you got to try to enjoy life while you go along the way. It's not just about how much money you can make. It's truly about being happy. And along those lines, I became a puppy father on Friday to an 8.5 week old Australian Shepherd / Golden Retriever. He's a black little muffin, and he falls asleep at my feet all day long. It's really something.
Is he going
Uh,
to present tonight as well, or do we get to hear from
uh,
him?
I can bring him up for a cameo if you really want that awe moment, but hopefully we can try to stay on point with the discussion. How's that?
Yeah, fair enough.
So a little bit about my background. I've been a CPA since 1990. I been on my own since 1994. I was a sole proprietor for a number of years, and then I started a firm in 1999 down in downtown Chicago in the Loop area. I had a couple of partners and about 10 staff members. Uh, we did all kinds of work, including audits and other things of true CPA nature, but always with a concentration of clients that always had real estate. It seems like the overwhelming majority of our clients, at least individually speaking, all have real estate, and that's really one of the primary reasons why they have us. Is because there's a lot to know about it. There's a lot of rules and a lot of complications, and really understanding those rules and how to deal with them and get around them and work through them, will really make you happy and hopefully very rich. I happen to have 4 rental properties, um, 2 of which I actually rent to myself. From my business to me individually, I have a 4-bedroom duplex in Colorado that I mentioned to you that I like to snow ski. I currently, which was a 1031 exchange property. I also have a property that I now live in Wonder Lake, and that's where we're coming from. I could literally step outside and you could see the lake. If you would like a highlight, maybe someone of skiing across the view. Remember, you got to play as hard as you're going to work hard to make these things work. I also have a 1-bedroom condo that I used to rent out, but is now my business office in the city. And last but not least, I own a family 3-bedroom townhouse in the Gold Coast area. So I'm not a multi-dwelling kind of guy. because it's just too much responsibility above and beyond what I can handle with hopefully taking care of just John Warren's taxes. But anyhow, John, thank you so much. Really, I'm really appreciative of this opportunity, and you've been very supportive to me and my firm. So thank you for this opportunity. I'm going to try to start my discussion now, and my overall topic is tax strategies and other considerations for the buy and hold real estate investor. So I think that probably encompasses most of the people from what I've heard thus far. And I highly welcome any interruption for questions or clarifications, or we can hold it till later, and we can go off of my topic if there's something specific that you would like to discuss. I am a constant pain in the ass, so hopefully I will have a good answer for you. So the first thing that I would like to discuss is really, as you get involved in this profession, understanding the rules and how they relate to how you want to operate is absolutely essential. And what I'm alluding to is understanding whether you are a passive owner, an active owner, or if you qualify to be a real estate professional. Your next question should be, Steve, why does that matter? Well, if you're a real estate professional, you are not subject to income limitations that happen if you are a passive or active owner. And there are certain qualifications to become a real estate professional. And I'm not certain if that's everyone's goal, because most people that are buy and hold investors aren't typically real estate professionals. The ones that are real estate agents and do syndication work like John does, and I believe Vicky is also doing some property management and has a portfolio of things that she has to work on. These people easily qualify as a real estate professional. And the general rules of becoming a real estate professional require you to do at least 750 hours a year and at least 50% or more of your time in doing that real estate activity. Let me put some context on doing the 50% or more. So there are a lot of people that work W-2 jobs and also do quite a bit of real estate investing. And if you do a W-2 job, and let's say you could do it full time and you work 2,000 hours a year, in order to qualify as a real estate professional, that would mean that you'd have to work 2,001 hours versus the 2,000 on a W-2 job in order to qualify as a real estate professional. And it's important to make the distinction on the real estate professional because, again, if you are a real estate professional, any loss that's created by depreciation or cost segregations, things of that nature in the business that are non-cash write-offs, you don't have any income limitation in terms of your ability to take those losses on your taxes, which can save you tens of thousands of dollars annually and significantly over your career. It could be the funding that you need to do that next improvement or buy that next piece of property. Now, if you say, Steve, this real estate professional stuff sounds great, but I'm never going to get there. What does that mean for me as a passive investor or an active owner running real estate? What it means is that there are limitations and you're subject to what's called the passive activity loss rules. The passive activity loss rules, let me, before I go into the passive activity loss rules, John, is it okay to interrupt to ask people if they have questions or need? Or
yeah, of course. Yeah, exactly. And feel free, people, to chime in.
I don't want to just be all technical. You know what I'm saying? It's more beneficial because usually the people who have questions, everyone has similar questions. So please let me know if if you have any things that you would like to add at this point that I could answer.
Yeah, I mean, I don't know if anybody has questions or not. I know that for me personally, that this has been really important for me for tax purposes, being classified as a real estate professional. So yeah, I would say just keep going. I'm sure more questions will come up.
All right, no problem. So, but if you're not a real estate professional, then you're subject to the passive activity loss rules. This is extraordinarily important because these things affect your strategies as a business owner in real estate. So here's how it works. If you're subject to the passive activity rules, then losses on your Schedule E properties are limited to $25,000 a year. And any losses above and beyond that are suspended. And that happens when your income reaches $150,000 or more in the year. At that point, you get no losses on Schedule E, and all of your losses are suspended unless if you have what's called passive income. So, and as maybe you might be in a lower income bracket. If you're under $100,000, then you're allowed to take up to a $25,000 a year net real estate loss. And if you're between $100,000 and $150,000 is what we call the phase out. And you'd only get a percentage of that $25,000 if you're in that income range.
Steve, is that for joint filers or is that for individual filers?
That is for any filer. So if you're single, it's up to 150,000 or the income ranges I mentioned, or if you were married filing jointly, if the married filing jointly income is 150,000 or more. And if you file married filing separately, they split that in half to 75,000.
So if I make $150,000 in my W-2 job, that means I can't take any losses. Is that what you're saying? Like with depreciation?
The answer to that could be yes, and the answer to that could be no. Generally speaking, if you only had net real estate losses from your business, from your rentals, then the answer to that would be yes. However, if you have other passive income activities, that could be another property that actually generates net income, or if you have other investments, like you could be a passive owner in a bar or a restaurant or another type of business, or even a real profitable real estate syndication that generates net income. And though to the extent that you have passive income, you're then allowed to take passive losses. So in your case where you make 150 or more, you would need to have an activity or activities that generate net passive income. And to the extent that you have losses, you get to wipe out that income. And to the extent that the losses exceed that income, those become suspended losses in the future. And there are triggering events. Triggering events would be, again, in the next tax year, having passive income, or the sale of that actual property unlocks all of the suspended losses that may have accumulated over the lifetime of your investment. Great question. Any other questions?
Yes, Steve, real quick. Hi, Matt here. You said that the losses on the Schedule E properties are limited to $25K a year. Now, is that all encompassing, meaning total $25K, or is it per property?
25,000 is the maximum loss for all properties.
Okay. Good.
And again, you know, that's why you have to really understand where do you stand in this equation, and what are the tools in my toolbox potentially, or ideas or ways to work around that issue, Matt.
Thank you.
Sure.
Hi,
Anyone?
Steve, I wanted to
Yeah.
just circle back on that passive activity losses.
Sure.
So if you have two rental properties, one rental property makes you $1,000 a month, and then the second property makes you, let's say, $2,000. So you're getting $3,000 worth of rent of income after your expenses and such. Do you pay taxes on that $3,000 a month, or can you use that money to without paying any taxes on it, to buy another piece of property, or to update something in one of the buildings?
Okay, so you're asking a very and I'm sorry, it's John. Of course, it's John. If it's not John, in my card group, you're either a Mark or a Steve. There's 3 Marks and there's 4 Steves. Anyhow, all joking aside, it's important to really understand this equation. So, and I apologize, I lost my train of thought. Re-ask me your question just one more time. I went off script and I wanted to get back on script.
So you got 2 buildings. One building is making $1,000 of, let's say, net profit. Another building's making $2,000 of net profit. You're getting $3,000 of net profit out of the 2 buildings. And then do you have to pay taxes on that? Or can you use that money to go do other real estate related activities? So this way you can kind of hold off on taking that money and paying taxes.
Sure. Great question. And here's what I would say to you on this, Don. It's first of all, it's fantastic that you've created the cash flows, and it's more than likely, depending on the purchase price of your building, that those cash flows are going to come to you tax-free, because more than likely depreciation will wipe out those cash flows. Can you give me a basic, is this a residential property, and what's roughly the cost basis? What did
Let's say it's residential. I think most everybody on the call has residential property.
Yeah.
Somebody mentioned a multi-use property. And then let's say, the cost basis for one property is $100,000, and then the other property is $200,000. Let's say that they're 1% properties. I mean, I think that's they meet the 1% rule.
So here you go. This is a great example. So it roughly between the 2 properties, you got about $300,000 worth of cost basis. Rental properties depreciate on 27 and a half years straight line, which would kick off $10,909 of depreciation. And if I heard you correctly, it sounded like there's about $36,000 of net cash income above and beyond operating expenses. Was that roughly what you had said?
Yes. I mean, this is hypothetical. This isn't specific to
this is a great hypothetical. So with that in mind, you would actually have a net real estate income after depreciation roughly of about about $19,000. That would be considered passive income. And I'm sorry, what was the other gal that mentioned the $150,000 wages? If you then had another property, John, that created a depreciation loss, let's say a break even on the cash flow, but depreciation loss, that loss would net against that $19,000. And therefore, you could walk away tax-free in that year with all $36,000 of your money and not have a current year tax liability.
Okay. What if you don't have that third building to write off depreciation? Is there any way to get out of paying the tax? Can you reinvest that amount into doing more to the building, upgrading the current units in the 2 buildings? Can you, take that money and use it to purchase more property, but not hold off on paying on the taxes?
So almost everything that you mentioned will definitely have a beneficial effect. If you are doing capital improvements, then there'll be further depreciation, which is not likely to take down the bill as much. If some of these are more or less like cosmetic or getting the property back up to rentable condition vis-a-vis like painting and carpeting, you know, the things that you have to do when the units roll over, those are considered, you know, repairs and maintenance and or operating expenses. Usually now today, the way that we like to report it, we'll use like the description, you know, improvements less than $2,500 or painting expense, you know, because these things, you know, they really have relaxed the rules on how these things get recorded now. But yes, you could employ that strategy, or you could invest in another property, which would then further your play and how this would affect your taxes. So hopefully I've answered your question. If not, I'm happy to take another follow-up.
You did a really outstanding job. So basically what you're saying is that I don't need to pay taxes on that money if I use that money for something else real estate related.
Correct. You know, because at the end of the day, we're going to net down all of your business expenses as they relate to the property. You know, that would include all the things that you previously mentioned, except for the purchase of a new building. That's not just because you have net income and you roll it into a new building, you would still have to pay net income. So in other words, if let's say you had $50,000 of net income from your property, and I'm talking literally after all the things that you mentioned, the purchase of another property will not alleviate you from the $50,000 of net income that you have. Now, it may create more depreciation in that new property, and depending on the timing of when you got that new property, you might have a different sort of net out. But the activity of just buying a new property would not change the tax consequence just because you bought a new property. You know what I'm saying?
Okay, thank you for clarifying that.
No problem. That's why I like to take the questions, because as much as I have some stuff prepared, it's a lot easier to go to the heart of people's matters. And probably, again, what most people are thinking is very similar. You know, everyone's in this group because everyone's got properties that they're either contemplating or building their portfolios with. So if you want, I can continue, or I'm happy to take some more questions.
Steve, this is Matt again. Just real quick, John brought up something very interesting. So he's working with 36K of net income, and he's trying to invest with that and not give it to the government or taxes. We're running into a similar situation where we want to use our net income not on hard assets, but is there a way in the tax code, and obviously you could speak to this, where we can write that off as a loan to another subsidiary or a company? You understand what I'm saying? So instead of using it on purchasing or investing on a hard asset, we can use that and pull. I remember many years ago, it was something what Citibank used to do, where they would take their net income and they would loan it out and decrease their quote unquote net income, their line item.
You know, it may be different in the banking industry, you know, from an individual. If I heard you correctly, Matt, what it sounded like was you were going to take the net profit and use it to make loans to others. Is that correct?
Correct. We could take it as a loan to another individual, another entity, or another institution.
Okay, but if I can interrupt for a second, at that point that you would, let's say you turn around and you gave me a $30,000 loan, that would still be really considered an asset on your books. I owe you money. Mm-hmm. So in other words, it wouldn't be the loaning out of money at that point would be considered an asset to you. You're basically taking cash and saying, here you go, Steve, I'm going to give you a 6% loan because you need this as hard money and you can't get it anywhere else.
Correct. We're not using it to purchase another property. we want to get into, we're kind of finance experts me and my partners. So we wanted to get into not so much, we wanted to diversify, vertically integrate a bunch of stuff. So we wanted to get into like loaning out, like you'd said, like for 8% or something like that, instead of having to purchase. I mean, it's another option. So have you seen somewhere like that where in the tax code where we can reduce our net income? Yeah.
On the individual side, I don't think so. On a business side, where basically your asset is your money that you're lending out, and if you end up writing off those loans, either uncollected or otherwise, it's like relieving inventory. It's like you're never going to get that money back. So now you can write it off. So, and I'm not certain that's exactly the way that you were serving it up, but that's the way that I would understand it to be on the banking side.
Mm-hmm. Yeah. So like if we have like the 36K of net income, as John alluded to, and let's say we loaned out half that, we're only subject to only 18,000 of net income in taxes, correct?
No. That would not be correct, because again, the $18,000 that you're loaning out, you expect to get that money back. It's an asset.
Okay. So
yeah, go ahead.
No, go ahead.
It's the difference between an asset and a liability versus a profit and an expense.
So your general rule is if you're trying to subject yourself to less net or less taxes, using net income, you're saying like purchasing another purchasing another building or something like that's the better route instead of like loaning out the money.
Yes, it would be, because the thing that's great about the property or properties that are throwing off the $36,000 of net income allows you to, on the next building, look, any really good real estate investment at the very least is going to at least break even on cash flow, right? Meaning whatever it is that you're collecting, including the mortgage payments and what have you, if you break even on the cash and in the end you get tax bennies and you sell the property, or you 1031 exchange the property to further the play, you're going to still be golden. But in that scenario where you're pretty much close to break even on the money that you're taking in versus the expenses out, you will be creating a depreciation loss. And that depreciation loss, which is non-cash in nature, but is considered an expense, will wipe down or wipe out the $36,000 that you've made from the other proper buildings that you are making net cash flow. And that leads to one of the big points that I wanted to tell you about on Form 8582 for the passive activity losses. One of the tips or things that you would want to do to potentially, utilize your suspended losses is to either pay off your mortgage or buy a building with cash that's going to throw out net profit so that you can wipe down your other building that is, creating these losses. So that was really a great example that you gave me to work with.
This is excellent information. This is great.
I mean, I got more points, and I'm happy to have this back and forth. This is way better consulting, and I mean, I can tell you about all the freaking rules that you would really want to know, but really knowing how to work around these situations tailored to your own set of tastes and what have you is what makes my part of doing the business exciting, because I really like working with individuals and trying to find pieces to the puzzle to help them succeed.
Good question, Matt.
It's a beautiful thing.
So I can continue to throw it out there, or I can continue with some of the other things that I had prepared. Okay. So
Hey, Steve.
some notes that I took about what could be good in terms of examples to generate some potential passive income. And some of these are pretty basic, and if you can do them, they're great. One would be simply to charge more rent on your current property. Another way of, in other words, flipping, if you can make more rent and have the same amount of expenses, you should be able to create net income. You could refinance your current property to a significantly lower mortgage, or even consider paying it off. Again, with the idea that you're going to create more cash income, less outflow, because of the mortgage, and have net income. And let's see, if you can't do that, and I've seen, based on some of the conversations I've heard from others, let's maybe look and find another capital partner so that we can generate, cash owned, 100% equity, or 50% loan to value, or 60% loan to value type of properties that are going to create net income. And let's see, the other thing I had written down was, to consider the purchase of a new building that was for cash. So that's basically what we were just talking about. And let's see, I also came up with the idea or thoughts that you could look at other passive investments outside of real estate, because again, it doesn't necessarily all have to be in real estate. Maybe you've got some friends in other businesses that, that maybe, owning piece of a restaurant, a bar, a new business. If you take a gamble and it pays off, these things not only can generate income, but they can also soak up your losses that are coming from real estate.
That would include a brokerage account, like a standard stock account. Is that correct or no?
When you say the brokerage account, give me a little bit better context, please, Margaret, if you can.
If I can't claim my passive losses right against my real estate because I make too much in a W-2, but I also make passive income from a long-term stock portfolio, right? Those things cancel each other out, or no? Are they unrelated?
The lovely thing about our tax system is there's a lot of different buckets, and they have a lot of different rules. So as it relates to market gains, interest and dividends, and short terms and capital gains, those are subject to different rules. As it relates to passive activity losses, you have to think about ownership of businesses. Okay, so the stock market, and though, even though, yes, Margaret, as a category, the stuff that comes from the market is considered quote unquote passive income. But as it relates to the Form 8582 rules that lead rise to being able to take these losses that we're discussing, it has to be an operating business, not an investment activity. Pure investment activity. We're all investing in real estate, but that it's a business. It's not just I'm putting money in a market and hoping it'll just go up.
So so it has to be a private business, not a publicly traded company, is what you're saying. Like if it's a stock, it's a different category.
That's correct. It would be something that is of an entrepreneurial nature, that would be either in a partnership or an S corporation or a trust.
Okay. Thank you.
Great question.
Steve, can I add in something real quick as a possible income flow? Okay, so just recently I was talking to my partners, and they had a conversation with a syndication down in Kentucky. I forgot the name. I got to look it up. But here's something that might change a few lives here. So I know a couple of people purchased, or they're house hacking like 3 or 4 units recently. I just heard in our breakout rooms. There was a building, and it's obviously massive, but it can be applied to 3 or 4 units or whatever. A possible revenue source is the laundry machines or anything of the sort, an appliance. So here's how it works. So I spoke to the partners, and they told me a scenario where they've got a large 200 unit building, but again, using down to 4 or 5 units. They don't put the laundry machines the units don't come with the laundry machines. What they do is in their contract or their lease agreement, all the units are, equipped to handle laundry machines, so they're piped up and whatnot. What they do is they go to a rental company, like a Rent-A-Center or somebody that's familiar with it. They charge like $40 a month or something like that. And what they do is they charge $100 extra in rent. They're literally netting $60 per unit as a line item in all their units. So in the case of this unit, I think they had 20, they're netting $1,200 extra a month just by not owning the equipment. Plus you don't have to have CapEx, you don't have to have this, if something breaks, they're responsible for it. It's a beautiful, beautiful system.
And I'm sorry, what was your name again?
Matt, it's Matt.
I was looking for your name at the bottom of the screen. I apologize.
Oh, GCB.
Yeah, right. I'm like, who's this SM? All right. Thanks, Matt. Sorry. So really, and again, sometimes I talk more in generalities than specifics. So your example that you have given is where I said charge more rent on your current property. I'm using that maybe generically. What you have beautifully demonstrated is that in a building, especially in a bigger building with a lot more units, you could have other auxiliary income that increases your bottom line, or I should say increases your gross revenues for the year. So what you're saying is you've got a built-in $60, per unit per month per profit. So depending on the number of units, and especially if we're talking 100, 200 type of units, that's a hell of a cash flow, and that's a nice bottom line pickup. Which could lead you to other auxiliary services that you might consider. I can't tell you that I know what that next thing should be, but as it might relate to the property, that could be, maybe there's a pool area and you charge for the pool. And you know what I mean? So there are other ways of adding auxiliary revenue as it might relate to the units.
Yeah, Steve. Another thing was they added a dog park, which is huge. I didn't even think about it. So yeah.
Well, I got a little guy right here. Where's the dog park?
Oh, it's in Kentucky. Well, the partners are in Louisville, like Kentucky. It was just something my partners told me, and I was just like, whoa! It just blew my mind. I'm like, they're literally making cash off of laundry machines, like as a separate line item. It's pretty cool. I don't know.
Yeah, well, it's always nice when you can hit either the ball over the fence or put it in play, and it works out like that,
Mm-hmm.
Any
Hi,
other?
Steve, it's John. Are there any, so with passive income, are there any special tax brackets for that, or does that just become taxed at the ordinary tax rate?
The passive income is considered ordinary income, and that's why it becomes really important to understand this distinction between being stuck with the passive activity loss rules and potentially being a real estate professional. Now, one thing I'm not certain if I mentioned or not, but for those that are in the audience that are married and maybe has a spouse that either works part-time or not at all, they're the person that you really want to try to push and have the discussion about maybe becoming a real estate professional, provided that's something that the family wants to do, because it doesn't matter who the real estate professional is in the family. It counts the same way on a married filing joint return, whether one is a W-2 earner and the other one's a real estate professional, or if it's just one real estate professional and that's what the family does, per se.
Thank you.
With the whole goal of bypassing, these loss limitations. So again, it's really vital that you really understand this, so that, because ultimately it starts to drive some decisions. How much equity should we put in this next property? Maybe we would be good to have one paid off property and then maybe have one highly leveraged property. You know what I'm saying? The one that would throw off net income, and you're generating enough to, have the down payment on something that's other highly leveraged, and then they would offset each other. Therefore, the cash that you would get from the profit maker would be offset against the one that's leveraged.
Great point.
I can ask another question, but I feel like I've asked a lot of questions. So if anybody else wants to ask a question.
Margaret, keep coming at it, because your question means that some other person probably has the same question.
How do I think about depreciation when I live in the property? So it's both my household, right, my primary residence, but I also rent it out. Do I get to depreciate that, and how does that work?
Tell me, it's so your primary residence is it multiple bedrooms and you're renting out one of the bedrooms? Is that what you're doing?
I own a 4-unit, so I live in one of the units and the other 3 are rented.
Gotcha. Okay, so in that set of circumstances, and this is most common in 4 flats in the city, and someone usually takes the plum unit or takes the smallest unit to get the most amount of rent, whichever the case may be. I won't ask you which one you fall into. How's that?
I'm in the smallest unit, I'll tell you. I want the income.
Yeah, of course, man. I could tell by the modest smile that was going to be the answer. But that aside, what you have to do is look at the relative square footage of the 4 units and figure out what's the square footage of your unit as a percentage of the total square footage to determine that's your primary resident. And then that percentage times the purchase price is going to be your primary residence cost basis. And then the other 3 properties, most people for convenience probably would just split them up in 3, 3 equals. Or if you really know the square footage, then you can use that format.
And then if you move out, do you just start to depreciate that at a different, on a different schedule?
Well, if you were to sell a building that had 3 rentals and 1 primary residence, you would have an exclusion on the sale portion of your primary residence, and the other 3 would be subject to all the regular depreciation, recapture, potential rules, and what have you, and depending on, if you made a profit on the sale above and beyond.
If you don't sell it though, like you just purchase another one and then you start renting this unit, right? You rinse and repeat.
Are you talking about on your particular?
Yeah, like in the future, this one is then rented, but I haven't depreciated it, but I've depreciated the rest of the building.
Well, the minute that you would move out from the primary residence to, maybe you would upgrade to a single family or something different, whatever the case may be, that property would start to be an investment / rental property. And after 3 years, you would lose the exclusion that you could have on the sale of a primary residence, which is really, when you're in a multi-unit building as your primary residence, it's kind of rough in the respect that it's very generous with the primary residence rules. You're allowed to exclude up to a $250,000 gain on the sale of your primary residence. So you don't want to be at war with yourself. How much could I save in taxes and walk away cash free, no issues, as opposed to, forget it, rinse, wash, and repeat. And now it's going to just earn income. And that was really my intention anyways. And now I'll make whatever the new property will be now my primary residence.
Got it. Okay. I think I'm following. Thank you.
Great. Anyone else?
Do you mind, Steve, elaborating on that depreciation recapture that you mentioned when you were answering Margaret's question?
Sure, be happy to. Whenever you sell a property, John, there's elements of gain from as it relates to, you bought the property for $500,000 and you sell it for 700,000. Okay. Well, I made a $200,000 gain. No, not exactly. Because you had that $500,000 property, magically for, and it's a residential property, magically, for like 13 and 3/4 years. And so you've depreciated the property in half. So your $500,000 property, has only a cost basis of $250,000. Okay, you with me so far, John?
Yes.
Thank you. And when you sell the property for $700,000, there would first be recapture of the depreciation on the $250,000 that you took over the 13 3/4 years of owning the property, to bring the basis essentially back to $500,000 original purchase price. That all gets taxed at depending on your income level, but assuming that you're above the 25% tax bracket, you would pay 25% as a depreciation recapture. To the extent that you are in a lower marginal tax bracket, then you would only be taxed at that lower marginal tax bracket. Now, as it relates to the bigger nugget of the $700,000 now versus $500,000 cost basis, that $200,000 would be treated as a long-term capital gain. And again, depending on your income level and what have you, you're more than likely to pay 20% or maybe even 23.8% because of the net investment tax. And I can go into that if you would like as well. But just generally speaking, to try to keep it simple, so that the $200,000 piece, 700,000 minus 500,000, gets treated as a long-term capital gain as you would normally expect. And by the way, those gains, Margaret, you mentioned something about, your investing. If you have real estate, if you have market losses, that will wash out against the sale of real estate property. But back to the question that you were putting forth, John, the other $250,000 would be subject to depreciation recapture tax, up to a maximum of 25%. So that's kind of how it works, to try to keep it as simple as possible without making my head spin or your head spin.
Oh, that's great explanation. That actually helps quite a bit. I did have a follow-up question, but I feel like just like Margaret taking up
John, please continue, because I guarantee you the people that aren't asking questions probably have the same questions and then some.
Have you heard of Delaware State Trust for 1031 exchanges?
I have not. I mean, I've done a couple 1031 exchanges myself. And we've had a number of clients do them, including our fearless leader, John, who we got to learn about what a drop and swap is all about. But I unfortunately cannot opine on this Delaware State 1031 exchange that you're mentioning. But
That's true.
Generally speaking, that I might be able to answer about it, or, my advice in these circumstances, and Christina probably would agree with me, is first off, start with Google, then go to irs.gov and start to do some tax research on trying to get some more specifics on your pinpointed question. If I can't give you a further follow-up.
I messed up on the name. It's actually Delaware
Statutory Trust. Yep.
Trust.
Yep.
Yeah,
I only know this because
it's
of
not
John.
Delaware
Yep.
State, it's statutory.
So unfortunately, I do not know anything about the Delaware statutory 1031 exchange. But is there a set of circumstances that it might be relevant for this group to understand?
What I hear, I'm not an accountant. I work in the healthcare industry. But what I've heard is that you can do a 1031 exchange instead of buying a like property, which real estate. So you're selling one real estate asset, you can transfer over the funds into this trust and still get all the same benefits that you would out of a 1031.
I got you. So in other words, it's a way to kind of walk around the like kind, meaning, you know,
Yes.
you're exchanging, but this would be very interesting to know. I didn't mention this, and not that I have great knowledge because it's very recent new tax law, but one thing that should get on all of your radars as you grow in the real estate industry is qualified opportunity zones. So there are great tax benefits that can come from it. I don't know enough to really guide anyone through it, but I can definitely tell this group that is very serious about investing. And as you start to accumulate wealth and what have yous, qualified opportunity zones, if they stay in the tax code, was really certainly put there by Jared Kushner, not for poor people, even though that's what it's supposed to benefit.
Steve, I could jump in a little bit on the question that John mentioned on DSTs. So this is not from an accountant perspective. I mean, I know a little bit about them, and it's true that you can use DSTs for a 1031. So say your 1031 fails, right? We know it's all very competitive to find a property, and you may not find a replacement property. A DST is an option to put your funds into. And basically you're investing, and I don't know if that's the proper terminology, but you're putting your funds into a stabilized asset. And the downside is DSTs can be a bit expensive, and their return is about 6%, at least what I've looked at, cash on cash, and their IRRs are about 10%. So depending on what your numbers are, right, it might be better just to take your passive losses, or it might be better to just put it in active syndication. But if you want to look more about it, Michael Blanc, who does a lot of syndications, has talked to Wellington Capital on his show specifically about DSTs and how 1031 investors can use it.
What was the name? Michael Blanc.
It was Michael Blanc. It's spelled like blank, BLANK. And he had an individual from Wellington Capital, and that person's been on a lot of different podcasts. So for whatever that's worth, that person has been around. So that could be just an introduction to what people like us are thinking about with DSTs.
Hey,
Awesome.
hey, John. This is Matt here.
Jump in really quick. Oh, sorry.
Oh,
I was just going to jump in, Jesse. I also, sorry, the DSTs. I believe you have to be an accredited investor to invest in a DST because it is a syndication. So I think a lot of people on the call, if you're younger or you're just starting out, a DST is probably not something you're going to look into anytime soon, unless and also the returns are really low, like Jesse said. So most people do it when they're towards the end of their career and they're just looking to preserve wealth, I think is what so I sat through several presentations from a group in Oak Brook that does these.
Yeah, and that's what I was going to say. John Warren, or the other John. I remember writing in my notes that there was something to do with a 1031 exchange into a DSD at Delaware Statutory. John Warren has somebody. They continue to receive payments from a limited partnership structure option, and the reference I had to that is an attorney named Bibek Das. Maybe they can point you in the right direction. That's the attorney I believe John referenced in the past. Bibek Das, Bibek Das, DAS. Hope that helps.
He was our guest last month.
Right.
Yeah, he was our guest last month, actually.
He has been mentioned. He has been mentioned on two different meetups. It was with Mark Ainley's meetup in early February. I have the notes here, and then the one last month as well. So twice he's been mentioned for DST. So there you go. Hopefully that helps. Other John.
Thank you, everyone.
I have a question. Is being a real estate professional the only way to avoid the phase out for
Well,
passive loss?
the answer is no. On the face of it, it seems like that's the way that it appears, that the only way to avoid the loss limitations is by being a real estate professional. But, again, if you are able to generate passive income to the extent that you would have been able to take these passive losses that get created by real estate, they will wash out. Or if you have other investments that create passive income, they will also wash out against the passive losses. So it's really about being able to either balance that equation, or you're subject to the rules, and or you become a real estate professional. Now, just so you know, you could have what I like to call in the business deferred gratification on the suspended losses from the real estate. So, okay, maybe you're not going to get a current year loss, which would be fantastic to offset your high income. However, when you go to sell that property and perhaps you're done, and you want to be done, you might get a big fat surprise in that you make a profit on the sale of the property. All of these suspended losses, they give you relief at ordinary income tax rates, and the gain that you generate is all at capital gains tax rates. And you may find that in the year of disposition, when these things all get unlocked, that you don't have a big fat tax liability that everyone talks about when you sell your property for a killing. So I've experienced a lot of unexpected consequences with a lot of different clients. So, it's just really a question of cash flows and being able to create those cash flows. That's why you want to be able to, work yourself to the point where you have enough equity in the property so that you can generate net positive income that gets washed out by depreciation. That's what's going to line your pockets, and you'll worry about the day that it comes that you have to pay the big amount of tax potentially, if it's even that big, if you're on the deferred gratification process. So hopefully I've answered your question.
Can you talk about that a little bit more? So you're saying, okay, I make too much money to take passive losses, but maybe I'm just really bad at this and I don't make a lot of money. So I have all these losses that have piled up. When you sell the building, all that does end up counting against your income? Or how can you, I'm a little lost.
So going back to the hypothetical $500,000 example, where we were able to take a $250,000 worth of depreciation. Let's say that in a perfect world, you broke even on the cash that came in versus all the expenses that went out, and you're sitting with a $250,000 suspended loss. Okay. Now, depending on how much income you make, say you're in the highest tax bracket or whatever the case may be. Okay. And it's usually more about the people who are in the highest tax bracket, because then that $250,000 gets wiped out in the highest tax bracket. And first of all, there's only a 25% tax on that piece of the equation. And there's roughly pretty comparable in the highest tax bracket, you would also be paying 23.8% on the long-term capital gain on the federal side as well. But you would be saving taxes on $250,000 in the 37% currently, likely to go to 39.6% here very shortly. Bracket. So, if you do the math on it, 250,000 times 0.37, okay, that's 92,500. But then if we were to look at 450, and let's say I just use 25%, that's $112,500. Your big tax after walking away with probably, depending if you paid, if you paid for it all in cash per se, you're going to have $700,000 and you'll have a $20,000 tax liability. Does that suck? I don't think so. But that would be the net out, meaning the depreciation losses that you never were able to take, you get them in the final year at your tax margin bracket rate that it's at, but you pay gains in a much lower tax bracket, and you only end up paying the net spread.
That's
And
really
our high,
interesting.
so in essence, you get the deferred gratification, where it would have been great over the life if you had just gotten the free cash, you know what I mean? And then you'd probably be looking at a 1031 exchange,
Right.
assuming that you're going to stay in the game and you're willing to up the chip, or you have the deferred gratification. You know what? I'm out. I'm happy. I made, a nice return on my money. Okay. Steve says there's only about a $20,000 tax hit. Who fucking Ray, right? We're never going to be upset about walking away with $700,000 and having to pay $20,000. Hopefully there was a lot of joy and not too much aggravation over the life of the investment, right?
Thanks for explaining that. That makes a lot of sense.
Thank you. Thank you.
So Steve, I'd say we're getting towards the end here. Maybe we could do like one last question to kind of round out the session tonight.
Sure, please, fire away.
Anybody have like a last question they want to get out?
Is it possible to say more about qualified opportunity zones?
Well, I'll give you what little I understand of it. And I apologize. It's such a new animal, and I have no one yet in my portfolio of clients that have gone there. You know what I mean? I do have some high net worth people, but none that has one that maybe asked me a question about it.
Okay.
But,
well, maybe a source for information would be.
No. Let me do what I best as I can. So if you sell and make a large capital gain, it doesn't necessarily have to be real estate. I believe it can also be stock market. So that might make Margaret happy to know. But you take that net profit and you get to roll that profit into the qualified opportunity zone investment. And if you hold on to that investment, I believe, and this is where I don't know the rules, it's either 10 years or 15 years, you never, NEVER, have to pay taxes on it.
Like 10 years.
And it's 15 years?
10 years, according to the IRS website.
10 years, okay. Again, did you Google?
No.
DuckDuckGo, but
Yes, I could
same thing.
Google them.
As if Dr. Google, man, he seems to never, he never seems to get it wrong. But if you cash out before then, I believe that there's still like a 15% exclusion of the overall gain, and then you have to pay the representative taxes.
That's not bad.
So, and when you're talking about, a high-rise owner of New York where you got, hundreds of millions of dollars of monies, it's not a small play for most of us, but for the people that are really loaded or, have been able to accumulate enough in life, and hey, I'm going to do something noble, and I'm going to invest in an underprivileged area, and I'm going to do what the law was put out there to do, and
So
feel
that's the
good
point
about
of
that.
it.
Right. Exactly.
To invest. So we are definitely poor neighborhood adjacent here. So.
Well, and that's why I said, it should definitely be on your radar. It's fairly new, but not to the people who are extraordinarily well-to-do that always get involved in these things that have, super high-priced attorneys and super high-priced accountants. I'm only high-priced, not super high-priced. Right, John?
That's why we're friends.
Yeah, I told you, it's all about being a constant pain in the ass. So, anyhow, did I answer the question? Because I would just like to say thank you, John, for this opportunity. It's really been a pleasure. I'm not usually a big fan of public speaking, but this seems more like my poker club where I've got 18 other dudes on the line and everyone's blowing each other some shtick. So
I love it. And Steve, I'm going to throw your email into the chat after we're done here. So everybody, if you have questions for Steve, or, if you want to kind of follow one of these rabbit trails a little further, you can reach out to him individually. So no, I really appreciate it, Steve. This was great. Really good time, good conversation tonight. Really appreciate it.
And I am very happy to take anyone's email. I will do my best to try to get back as soon as I can. Please understand that even though quote unquote tax season ended, tax season hasn't ended, right? Christina, where are you? You haven't said a peep all night. She there?
Oh, we caught her stepping away.
I was going to say you look pretty good for tax season. I feel very miserable.
There you go. Awesome.
It's the ability to continue to do the things that you love to do, despite having to perhaps work almost every single day. So you can work and you can play, and it is definitely rewarding. So that